a more macro outlook, but I very much want to get his thoughts on Telstra too. Jack Lowenstein is the Managing Director and Chief Investment Officer at Morphic Asset Management, and he joins us from our Sydney CBD studio. Jack, thanks very much for joining us. Now, I know you look a lot at overseas markets. We are going to talk some macro issues on Australia, though. How have you seen Telstra today? I mean, it seems a lot of analysts have been distinctly underwhelmed. The vision thing wasn't there, according to them.
Well, also, I think the dividend thing might not be there. The only analyst report I've read which looks at where dividends are going in some detail suggests they're going to fall as low as 14 cents a share by 2021, having fallen to 18 in 2020 from the 22 at present.
Yeah, because it just cannot sustain these higher dividends.
Correct, and I think that the problem for Telstra is that it's very much a retail owned stock, people chasing fully franked dividend yields, and I think those numbers are unsustainable. It's paying a much higher dividend, or its dividend yield is much higher than most global telcos, and I think that reflects the fact that the current dividend level is not sustainable.
Do you think it's... Oh, sorry, go on.
But having said that, I think Telstra is now at a bit of an inflection point. We don't own it. We probably won't own it because we're not very keen on the sector as a whole. But compared to other global telcos, it's now starting to look, I think, slightly cheap. So specialist investors in the sector may start looking at it.
Yeah, well, that's interesting to say that, because also they still make a lot of money.
They do, and they make very high margins. I guess the question is, have they fully... are the present $8,000 staff cuts, are they enough? I was shocked to see that 1 in 4 of their middle management's going to go.
Yeah.
The suspicion is that the organisation is still quite fat, and that may be that they've been slower to adapt than other legacy telcos around the world.
Yeah, so you mentioned margins. What's the link there? I mean, their margins have been very high. Are they going to have to come down?
I suspect they will. There was one very interesting piece of commentary from one of the broking analysts who says that maybe the situation between Telstra and its competitors is a bit like it was when Qantas was at the peak of its market share wars with Virgin, and that only when they decide to sort of stop fighting over market share will margins start to recover. And that is probably a fair view, I think.
All right, let's move on, because I know you've been looking at, the very sort of broad measure of unemployment in Australia, and that this may be why you are shorting the Aussie dollar. Now, tell us why.
Yeah, so when you see the headline unemployment numbers for Australia, we're at 5.5%. That's actually quite high compared to the other countries we look at, which are primarily the US and Japan. US is about 4%, and Japan's about 2.5%. But when you look beyond those headline figures and look at underemployment, that's looking at the measure of people who want to work more hours or want to be full-time rather than part-time and so on. There the figures are quite shocking. So basically Australia's underemployment level is about 9.5%. That's worse than it was at the peak of the GFC. Yeah. And it's also a lot worse than it was during the 90s. If you go back to the era when I was first getting a job, anybody who wanted a job got one, and at that point underemployment was in sort of mid-single digits. Now you contrast that with what's happened in the rest of the world. Underemployment is still falling in the US. It's now back to pre-GFC levels, and in Japan underemployment is virtually non-existent. And I think the key issue that makes us focus on is interest rates in Australia are not going to go up, because the amount of slack in the economy is so huge. Because all those people who want jobs are going to keep wage rates down. So from our point of view... So you think,
inflation is just not going to happen here for a while, and that is what's really concerning the RBA. Although we do know that, banks have from time to time put up interest rates irrespective of what the RBA has done.
They may try to, but the competitive pressures are going to be there because loan growth is going to be very, very low, I think. But I think there's kind of good news and bad news. It's good if you're a middle-aged person with a large home loan, because your rates aren't going to go up. The bad news is that I think it's going to be very hard to get a job. Now, that means, in our view, that the interest rates aren't going to go up in Australia while they're rising in other markets, which probably is the other reason why we're currently not only not hedging our global exposures back into Australian dollars, but we're actually short the Australian dollar, because we think without any interest rate rises in a world of rising rates, the Australian dollar is going to fall further.
All right, so when you say, just take us through that a bit more slowly, you think the Australian dollar will go, what, below 71, below 70?
I believe it's going to go below 70, yes, and probably down to 65 over the next year or two. Because there's just going to be no interest rate pressure, and the economy here is not going to grow that fast, I don't think.
Yeah, so therefore that also puts us in a different light with the rest of the world, well, at least America, who are raising interest rates, and that seems to have put a bit of a bomb under their, bit of a rocket under their dollar.
Correct. But I'm not even sure that we'll raise rates before Japan does. That's a very bold call.
Wow.
We have got, that's how slow I think the progress on higher rates is going to be.
Okay, but just why would you short the Australian dollar?
Because we think the Australian dollar will do less well than it will fall against the US dollar, so we will make gains for our investors as the US dollar rises against the Australian dollar.
All right. Now, we've been seeing certainly today that the banks have been they've done well today, certainly. But how do you see these rallies in Australian banks? They're a huge proportion, really, of our index. Are they sustainable? What do you think is going to happen there?
Well, look, first of all, they have fallen a lot. I think they're down about 25% from their peaks, so it's been a big fall. So you always expect the odd bounce from that position. The question is, will they have loan growth and will they have margin improvement? I'm pretty sceptical at both those. And the next question is, will they face higher costs because of the Royal Commission and so on? I think the answer is probably yes to that as well. So I don't think we're going to see a lot of earnings growth at these banks, and nor do I think they have an awful lot of surplus capital which to buy back shares as they have done in the past. So those are kind of negatives in the medium term that I think are going to weigh on those share prices. Plus, of course, if Labor gets in and they do get rid of the franking credit excess payments, that's going to be taking out a whole class of current owners. Yeah,
exactly. Does that impact you at all?
No, it's actually, what it probably means is that most Australian investors who are underweight global stocks anyway will realise that actually there's no point in staying in Australia, or they need to re-weight towards global stocks because the previous incentive to stay, because the franking credits will have gone.
Yeah, all right. So, Jack, just interestingly, I mean, you do invest a lot overseas. You're fairly heavily invested in Japan. Now, there are concerns about these trade tariff wars between the United States and China. Given the way Donald Trump works and the very unorthodox way he kind of bullies people and then pulls back, are you not getting worried about that before some of the tariffs actually are implemented, supposedly on July 6?
Well, I suppose, first of all, we don't have any direct exposure to any tech exporters from Japan, from China.
No.
And what we're seeing at the moment is a wholesale dumping
but it
of
affects
Chinese
markets,
stocks.
I guess, is what I mean. And it certainly affected the Nikkei yesterday.
Absolutely. It's affecting confidence in lots of ways. And I think personally, it's a very bad thing. But it's also creating some opportunities for us as investors because, for example, we're currently buying one Chinese tech stock that's controlled by a global company because the market sold it assuming it's an exporter, but actually it doesn't export anything. It only services the domestic market, so we're very excited about it. It's a great opportunity.
Yeah. Jack Lowenstein, we will leave it there from Morphic Asset Management. Great to talk to you. Thank you.
Bye-bye.